This is Chuck Oliver. Welcome to this week's Hidden Wealth Solution Review. Well, our IRAs, or IOUs, to the IRS, that's coming from top CPA guru. I talk about Hidden Wealth Radio this weekend, Ed Slott. That's with 2 T's. If you've not looked at Ed's material, you can look his material up. He's got many best-selling books. And I had the fortunate opportunity to be kind of an underling to the advisor that worked with all of Ed's personal wealth clients, because Ed's a top IRA, RMD, Roth IRA, Roth Alternative IRA specialist, most highly regarded in the whole country. Many, I think, 4-decade plus CPA. And one of the things he had, and I talk about, I'm going to get right to it, Roth conversions to reduce taxes for inherited IRAs. Now, this has a lot of people wondering, but we're running into many of you that have inherited IRAs from your family, right? Father, et cetera. And I talk about one case where we helped. This would have been the first inherited RMD year for this client who was very confused by all the rules because they keep changing the rules anyway. And we used a little known deduction. I'll teach you this Tuesday at retirementprotected.com. That's retirementprotected.com, of a deduction for those that qualified that offsets the cashing in, so to speak, the inherited IRA. Now, that we have a whole wealth planning team that coordinates all this for compliance and a tax team that directs everything tax-wise. But this all came through to the letter, and now he doesn't have to worry about it because, again, you have 10 years. Our children, right, or if you're somebody that's inherited IRA, you have 10 years to fully, by the 10th year, to fully liquidate. So the longer you wait, the more tax you're going to pay. Well, some of the key points here, this really was shocking, and this was on CNBC. Only 41% of investors with more than $1 million in their IRAs have a plan for passing their wealth on to future generations, according to UBS. Now, as retirees, consider legacy. Now, some of you don't need the required minimum distributions. I think the clients we just met with this week where the client did not need what's going to now be close to a $100,000 required minimum distribution, and he did not know that he could avoid that. And there's a couple different strategies that we teach. Some are called Roth conversion laddering. Some are called strategic Roth conversion offset. Some are using qualified charitable distributions. There's definitely ways that you don't have to get stuck with this tax bill. But the strategy known as Roth IRA retirement account conversions, these are now becoming more of a piece of legacy, this article goes on to say. And with the Secure Act, right, those before 2019, you used to be able to stretch the inherited IRA out over the inheritor's lifetime. But when retirees pass away, their children will probably be in their peak earning years. I've always said this. At about the time we expire, is it about the time our adult kids will retire? And we're seeing this to be true now. So if you've inherited an IRA, you're in that boat, just like the client that we just helped this week, get completely out of this inherited RMD nonsense. That's where the government's in control. And now you can be in control. But how can Roth IRA conversions benefit heirs? Well, you still have to take the money out, but if you do strategic conversion now, so whether that's you talking to your parents, we had a client this week that wanted us to help his older father. We've had other clients that said you need to help our older adult children. The reality is this is legacy planning, and it's a lot of tax that can be avoided. Planning for higher income tax brackets, right? Tax rates are on sale, and just as Mr. Slott points out, right, the higher tax rates are on the horizon. And he talks about how Roth conversion is especially attractive before 2026. And I love how he said, your IRA is an IOU to the IRS. I've said that for a number of years. I probably took it from Mr. Slott, so I'll give him credit for it. One question that comes to mind is whether the government could decide to change the rules related to Roth IRAs. Now, I've shared this with many of you, but it used to be you could not convert if your income was over a certain amount, married, filing jointly or single. And then Obama's administration came in and said, in 2010, we're going to lift the income restriction. And not only are we going to lift it, but we need tax dollars so badly, subliminally they're communicating this, that we'll let you spread the Roth conversion tax that you convert in 2010 over 2011 and 2012. They were just giddy about getting more taxes, and they wanted to open up this Roth conversion special. Well, here's what's happening. Why consider conversions in 2023, 24, and 25? Tax rates are on sale. In essence, the government, because they needed money so bad, right, as they still do today, gave everybody an interest-free loan to build their tax-free savings over that 2011, 2012 time period. But listen to this. We're in historically the lowest tax rates most people will ever see, according to Mr. Slott, right? And they're slated to go up unless they increase because of budget deficits. Now, his point is CPAs know to write in pencil because everything can change. Just like the tax laws can change, Secure Act 1.0, Secure Act 2.0, Inflation Reduction Act, all these things can change. So he says, remember, a lot of your IRA is debt owed back to the government. Your IRA is an IOU to the IRS. Especially married couples, you have joint accounts, he says. You each own half. Your IRA is a joint account with Uncle Sam. Here's the difference. With a regular joint account, as just said, you generally own half. With the government, right, with Uncle Sam, you don't know what your half will be, and you don't know what it's yet determined to be on how much the government needs at the time that you start taking money out or they force you to take it out. Folks, you worked hard for your money. Go to retirementprotected.com. That's retirementprotected.com. And let me teach you how to get rid of Uncle Sam as your partner. Not only to you, but also getting rid of Uncle Sam as the partner to your kids, your heirs. You work hard for your money. Imagine more financial success, less stress, less worry, less taxation, things that we can control while tax rates are on sale. And believe me, folks, you don't want to be kicking yourself a few years down the road. And I'll leave this resource for you. This is the time to really get focused. We have a number of people this time of the year that are in a race to say, yeah, save tax. If you're a high income earner, right, you can still do Roth conversion and not add to your taxable income. There are ways to do that if you qualify. If you're somebody that did a really great job of socking away money thinking you're going to be in a lower tax bracket because you used to be in a higher tax bracket when tax brackets were 50, 60, 70%, and now they're in the teens and 20s, folks, there's still time. But you definitely want to take advantage of it. Go to retirementtaxcalculator.com. That's a free resource. In under 30 seconds, plug in all your not yet taxed, or I call it the tax me later money, the ticking tax time bomb money. Load that in. Husband and wife, if you're married, single, what you have in all the various IRA or 401k accounts, and put the toggle there, what you think the tax rate's going to be. And some of you really underestimate what that tax rate's going to be. But it's a free resource, and it'll tell you in under 30 seconds what tax risk exposure you're taking on. And folks, it's not just tax on what the government starts making you take that money out. It's then when you reinvest it, they get to tax it again. And then when you leave it, they get to tax it again. Let me teach you how to get away from the tax tidal wave and protect yourself and your family. Retirementprotected.com, retirementprotected.com.